Market anomalies are situations when a stock or a group of stocks performs differently from what the efficient market hypothesis predicts. The efficient market hypothesis assumes that stock prices reflect all the available information at any given time. But sometimes, there are factors that cause stock prices to deviate from their fair value. These factors can create opportunities for traders and investors who can spot and exploit them. One of the ways to identify and exploit market anomalies is to use functional investing principles. Functional investing is a strategy that focuses on the function or purpose of each investment in a portfolio, rather than on its performance or characteristics. Functional investing helps investors to align their investments with their goals and risk tolerance. There are four main functions of investments: growth, income, inflation protection, and liquidity. Growth investments are those that aim to increase in value over time, such as stocks or real estate. Income investments are those that generate regular cash flow, such as bonds or dividends. Inflation protection investments are those that preserve the purchasing power of money, such as commodities or gold. Liquidity investments are those that can be easily converted into cash, such as money market funds or cash equivalents. By using functional investing principles, investors can identify market anomalies that suit their portfolio function. For example, if an investor wants to add growth investments to their portfolio, they can look for stocks that have low price-to-book ratios, which is a market anomaly that tends to outperform the market. Or if an investor wants to add income investments to their portfolio, they can look for stocks that have high dividend yields, which is another market anomaly that tends to outperform the market. To exploit these market anomalies, investors need to act quickly and decisively before the market corrects itself. Investors also need to monitor their portfolio regularly and adjust their allocations according to their changing goals and risk tolerance. By using functional investing principles, investors can take advantage of market anomalies and achieve their desired outcomes. A functional investment strategy is one that aligns your investments with your goals and risk tolerance. It helps you create a portfolio that is diversified, balanced, and resilient to market fluctuations. Here are some steps to create and measure a functional investment strategy. Step 1. Define your goals and risk tolerance. What are you investing for? How long do you plan to invest? How much risk can you tolerate? These questions will help you determine your investment objectives and constraints. For example, if you are saving for retirement, you may have a long-term horizon and a moderate risk tolerance. If you are saving for a vacation, you may have a short-term horizon and a low risk tolerance. Step 2. Choose an asset allocation that matches your goals and risk tolerance. Asset allocation is the process of dividing your portfolio among different asset classes, such as stocks, bonds, cash, real estate, etc. Each asset class has different characteristics of return, risk, and correlation. By diversifying your portfolio across different asset classes, you can reduce your overall risk and enhance your expected return. For example, if you have a long-term horizon and a moderate risk tolerance, you may choose an asset allocation of 60% stocks and 40% bonds. Step 3. Select specific investments within each asset class. Once you have decided on your asset allocation, you need to choose specific investments within each asset class. You can use various criteria to evaluate and compare different investments, such as performance, fees, ratings, etc. You can also use different strategies to select investments, such as passive or active management, value or growth investing, etc. For example, if you have chosen 60% stocks and 40% bonds as your asset allocation, you may select an index fund that tracks the S&P 500 for your stock portion and a bond fund that invests in high-quality corporate bonds for your bond portion. Step 4. Monitor and adjust your portfolio periodically. Your functional investment strategy is not a set-it-and-forget-it plan. You need to monitor your portfolio regularly and adjust it as needed. You may need to rebalance your portfolio to maintain your target asset allocation if it deviates due to market movements. You may also need to review your goals and risk tolerance if they change due to life events or personal preferences. For example, if your stock portion grows to 70% due to market appreciation, you may need to sell some stocks and buy some bonds to bring it back to 60%. To measure the effectiveness of your functional investment strategy, you need to compare it with a benchmark that reflects your goals and risk tolerance. A benchmark is a standard or reference point that you can use to evaluate your portfolio's performance. For example, if your goal is to beat the inflation rate, you can use the Consumer Price Index, CPI, as your benchmark. If your goal is to match the market return, you can use the S&P 500 as your benchmark. You can measure your portfolio's performance by calculating its return and risk over a given period of time. Return is the amount of money you earn or lose from your investments. Risk is the uncertainty or variability of your returns. You can use various metrics to measure return and risk, such as annualized return, standard deviation, Sharpe ratio, etc. You can compare your portfolio's performance with your benchmark's performance by using relative measures, such as alpha, beta, tracking error, etc. Alpha is the excess return of your portfolio over your benchmark. Beta is the sensitivity of your portfolio's return to the benchmark's return. Tracking error is the standard deviation of the difference between your portfolio's return and your benchmark's return. A functional investment strategy that matches your long-term goals and risk tolerance should have a positive alpha, a beta close to 1, and a low tracking error. This means that your portfolio should outperform your benchmark on average, have similar risk exposure as your benchmark, and have consistent performance relative to your benchmark. By following these steps and measuring these metrics, you can create and measure a sustainable functional investment strategy that matches your long-term goals and risk tolerance.